Debt market update. G-Sec yields moderated during the month with 10-year G-Sec yield ending at 7.14%, 3 basis points lower compared to end December 2023. The yield at the short end remained at elevated levels due to tight liquidity, thus flattening the curve further. The key factors and events which influenced the fixed income markets included consistent buying of G-Secs by FIIs, a benign domestic CPI, rise in oil prices, and strong US economic activity. Corporate bond spreads over G-Sec remained largely unchanged during the month. Average interbank liquidity fell month-on-month driven by rise in currency in circulation and elevated government balances. This kept overnight rate close to upper end of RBI's policy corridor. FPIs bought including voluntary retention route debt worth $2.3 billion in January 2024. Cumulatively, FPIs have bought debt worth $9.5 billion in 10 MFY24. On February 1, 2024, in its interim budget, central government announced fiscal deficit and market borrowings for FY25, which was lower than market expectations. Further, it reiterated its commitment to bring down fiscal deficit below 4.5% by FY26. These resulted in broad-based rally in yields. Outlook. The outlook for fixed income remains favorable over the medium term in view of the following key drivers. The lower than expected budget deficit and market borrowings are a significant positive because of improved demand-supply balance, as demand is likely to remain robust in FY25 due to India's inclusion in the JP Morgan Bond Index. Core CPI momentum remains subdued, driven by lower input price pressure and benign global commodity prices. Inflation expectations also remain well anchored and are trending lower. Major global central banks, especially the US Fed, have indicated the end of the rate hiking cycle and are likely to start easing in due course. RBI is also expected to follow soon by easing liquidity and eventually reducing the policy rate in coming quarters. It will also get more confidence due to the commitment to fiscal consolidation outlined by the government. India's external sector vulnerability remains low due to high foreign exchange reserves, range-bound oil prices, robust services exports, and the likelihood of FPI inflows into the debt markets in FY25. However, there are following risks to the favorable outlook. SLR holdings of the banking system are high and credit growth is robust. With interbank liquidity in deficit, the incremental demand for G-Secs is likely to remain muted. Regular food price shocks can keep headline CPI elevated and can adversely impact inflation expectations. Escalation of geopolitical tensions can impact exports as well as increase oil prices. Continuation of tight monetary policy for a period longer than expected can result in global yields rising. Overall, in our view, yields are likely to trade with a downward bias and the long end is likely to outperform over the medium term. While we continue to recommend investments in short to medium duration debt funds, investors could consider a higher allocation to longer duration funds in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.